this is actually, I think, a crisis developing within the precious metals market. And what we see in gold, we're also seeing in silver. The story in silver is obviously different, but China again has been a big player in silver as one of the leading global mining nations. Not only that, but over a long period of time, they've been importing silver doré, refining it, hanging on to silver, but using their clout to keep the price suppressed. That's no longer happening. So we've got shortages developing in silver now, too, as far as Western capital markets are concerned. I mean, the fact is that, pricing of these things is no longer under our control. It's all gone on to Shanghai.
Gold is once again testing record highs. Silver is showing wild volatility not seen since 2011. UBS, JP Morgan, and Citi have all raised their gold and silver forecasts, warning that this next leg is driven by physical shortages, not speculation. But according to veteran economist and monetary historian Alasdair Macleod, this isn't a normal rally. What's unfolding inside COMEX and the London Bullion Market Association could ignite a derivative market implosion capable of shaking the entire global system. For decades, Western institutions suppressed real value through paper contracts while physical demand quietly exploded overseas. Now that control is slipping away, COMEX vaults are draining, Western inventories are thinning, and the power to set prices has shifted east, to Shanghai, where delivery means delivery. Macleod warns the next shock won't come from inflation data or the Fed. It'll come when paper markets collide with physical reality. So the question isn't if the system breaks, it's who will be left holding the promise and who will be holding the metal. Let's go back to watch Alasdair Macleod's interview.
What we're seeing is the squeeze on the establishment, the people who are short, not just establishment. I mean, if you look at the commitment of traders figures, you'll find that even managed funds have short positions. I mean, they're net long, but they've still got some short positions. The swaps, obviously, a big net short. The liabilities that are mounting up on the shorts are just staggering, absolutely staggering. So, yeah, it's a squeeze on the system. And I think actually, Danny, what we're looking at, if you stand back, we're looking at the dying days of the fiat currency system. And, that basically means that after a period of time, it doesn't matter don't know how long it'll be, but I suspect it won't be all that long. Unless governments actually manage to pin their currencies to gold, they'll become valueless. They'll go down to close to zero. I really can't see the politicians even thinking that they need to protect their currencies. They're still spendthrifts. They're still, having huge, great deficits on their budgets. They don't care. They just complain that the markets need higher interest rates. Well, it's hardly surprising. You're going to need higher interest rates still. And meanwhile, everybody in the market, in this credit bubble, assumes that inflation is going to diminish. But I mean, the thing they get wrong is it's not, sort of prices, if you like, in that sense. It's the loss of purchasing power of the currency. That's what they've got to look out for. And if I'm right that we are in the dying days of the fiat currency system, then prices are going to soar in the next 2 years. And that is something which, of course, nobody expects. But it won't be prices going up. It'll be the value of currencies going down, their purchasing power collapsing. And, of course, as soon as people realize that, they dump the currency for anything they can get with it. I think that's the future. I'm very sorry to say. Well, it's not impossible. I think we have to, if you like, divide out bullion banks from others in the market, as it were. I mean, bullion banks will try and run a balanced position as much as possible. Where they're short on COMEX, they're probably long in London, sort of thing. But when you've got hedge funds, when you've got people, and maybe market makers just making a market in the swaps rather than having positions in London as well, then they could become, if you like, a systemic problem, which I think they try and cover up. They must try and cover it up. I think it would. I mean, it's not impossible that a bullion bank will get into difficulties, but I think it's more likely it's amongst their clients that the difficulties will arise. That would be my view, anyway. Well, within the COMEX rules, they can declare force majeure, but nobody's going to want to see that at all. I think what's likely to happen is there will be a rescue behind the scenes. We won't know about it. It'll be hushed up. It'll be very, very quiet, but it will happen. And it wouldn't surprise me if that happens quite soon. But, we're not to know about it, because if you get a failure in these markets, particularly gold and silver, this could undermine the whole of the derivative industry. I mean, because we're not just talking about, those derivatives. I mean, they are central to everything. Just think about the extra pyramid, with gold at the bottom supporting everything else. I mean, that might exaggerate the position a little bit, but you can see how important gold is in all this. And if you get a failure in what is actually legally money and all else is credit, the failure in real money counterparties, then, this is serious. You've got to bear in mind that the market has moved. It's now over in Shanghai. I mean, the physical market's over there, not over here. Yes, absolutely. I mean, it's in terms of, if you like, contagion from gold and silver derivatives. Yeah, I mean, you've got the same counterparties operating in all these markets. So you are going to get that contagion, if you like, spreading across. And it's not just those markets, because once you spread from gold and silver into other commodities, you also, going into counterparty failures in the other really large derivative markets, and even in foreign exchange and things like that. So, it's got to be stopped, basically, and they will stop it. But as to your point about commodity prices rising and all the rest of it, I would note that gold is leading the way upwards in commodities. And my view is that it's likely to drag other commodities like base metals, for example, and energy up with it, but particularly base metals. I mean, they are, relative to gold, they are now cheaper than they have ever been. And since gold is the real money standard, as it were, even though that's being driven up, if you like, by markets, I would see that all these relationships are going to come under huge, huge strain. And it's not good for the purchasing power of paper currencies. Well, I think there's an increasing likelihood that the credit bubble will burst, come to an end.
Alasdair Macleod believes we're witnessing the final phase of a monetary era built entirely on credit. He points to deep cracks already visible, runaway government deficits, central banks trapped by inflation, and a derivatives market now exceeding $2 quadrillion in exposure. The entire structure depends on one fragile belief, that counterparties will always make good on their promises. But what happens when one can't? Macleod warns that a single major failure could ripple through markets faster than regulators can react. Bullion banks and hedge funds sit in dangerous territory, short on COMEX while long elsewhere, trying to balance risk as physical supply disappears. Over 1,000 tons of gold and tens of millions of ounces of silver have already been stood for delivery this year. A clear sign investors want bullion, not paper. ETF redemptions and LBMA outflows tell the same story. The West is losing its gold, and Asia is taking it. China, India, Singapore, and central banks from Poland to Turkey are paying premiums just to secure supply. Meanwhile, Western fund managers remain overloaded in tech and bonds, with virtually zero exposure to metals. If only 1% of global portfolios shifted into gold, it would require 25,000 tons of physical supply, metal that simply doesn't exist outside Asia's grip. That's why Macleod calls this not a market correction, but a monetary reset already underway. Public trust, the foundation of fiat, is evaporating. Liquidity keeps the illusion alive. Once it dries up, confidence collapses and currencies follow. This isn't about gold or silver rising. It's about paper money losing purchasing power. As he puts it, when confidence goes, money flees into what's real. That's when people rediscover that gold and silver aren't commodities. They're money itself. He expects quiet rescues when bullion banks stumble, behind-the-scenes operations meant to stop contagion. But every hidden bailout only proves what the market already suspects. The system is running on trust alone. Leverage across global equities now tops $1.2 trillion, according to FINRA. If markets drop just 20 to 25%, forced liquidations could explode, wiping out margin accounts, freezing derivatives, and driving a stampede into physical assets. That's when gold returns to its true purpose. Not speculation, but survival. Let's go back to watch Alasdair Macleod's interview.
Now, if that happens, it's going to unleash, I think, major developments in the markets. I mean, apart from anything else, something like a 1987 style crash or a 1929, October 1929, both October, incidentally. You know, this is quite a dangerous time historically. That style, you know, that sort of scale of move down is going to create huge, great problems because the amount of leverage in the market is at record levels. I mean, just look at the figures coming out of FINRA. I mean, the end of August, the level of leverage was about 1.2 trillion, I think, from memory. And that's up 4 or 5 times since over the last 10 years. This is huge leverage in the market. That gets unwound very quickly. And you find that, so, while, if the market drops 25%, say, when it starts, then, a lot of these leverage positions are going to be just completely blown out of the water. And the experience of a deflating bubble, particularly when you've got the complexity of tariffs put on top of it, trade tariffs and all the rest of it. I mean, it's just like 1929, and this is not good. But this time it's even bigger. It's bigger than 29. I mean, a lot bigger. So whether it happens in the next month or two, I don't know. I think it's quite likely to happen by the year end. And then, of course, that's going to have a huge, great impact on bullion, because if you think about it, I mean, every market's going to be in the same position. Some people will have, think they got wonderful profits in bullion and they'll cover the losses by selling bullion. But apart from that short-term effect, what we're likely to see is a flight out of paper into physical bullion. I mean, just get the hell out of paper. It'll start in the financial markets, that move. So it would drive, and think of it from the point of view of a large investment management organization with their clients holding no gold at all, which is par for the course, long up to their necks in tech stocks and whatever. When that starts collapsing, where do they go? I mean, the answer is they try and get out of the falling stocks as quickly as possible, and anything where they can sort of rescue something. But on the margin, they're going to be saying, well, the one thing we haven't got is bullion. We've got to get into safety. And I think that's what the foreigners will do, probably more, initially anyway, more than domestic institutions. The problem is, Danny, that there just is not the bullion there to satisfy the potential demand coming out of institutions. And we should note that analysts at the big banks are now forecasting higher gold prices. But their investment managers haven't got any. So what do they do? I mean, where do they go? If you look at how much gold is really required to satisfy just 1% of portfolio allocation across the world, you're looking at 25,000 tons of gold at current prices. Now that is just not there, because China's cornered the market. And nobody else wants to let it go either. I mean, okay, there are a few traders and so on who will let it go. But, if we're talking about physical, and we're not talking about paper, if we're talking about physical, it's just not there. and the paper market, what does the paper market do? I mean, basically, what we can see is a likely major move into metals because they are performing, gold and silver anyway. And because it's not there, prices go through the roof, crisis ensues. So I think this is the danger. I mean, I think it would be dangerous, I think, for me to forecast this as such. So I don't come out with forecasts, but I just look at the dangers, if you like, that are likely. And this, to me, is the big danger at the moment. Nobody's got gold. Nobody's got physical gold in the West. They're running an awful lot of portfolio money. And at some stage, they're going to try and move over. And when you've got, people like Goldman Sachs saying, we expect gold to go to 4,000, whatever, by the end of. I mean, I don't know whether they're talking any sense at all. Probably not. They're probably just looking at the charts. But you can see how, this actually leaves the investment managers who got none in a bit of a pickle. What do they do about it? And the gold isn't there. They can't get it. I mean, you've got parties who we don't know who they are, who are standing for delivery on COMEX as the only way in which they can get any physical. And so far this year, I mean, I reckon it's about 950 tons has been stood for delivery on COMEX this year alone. By the end of this year, it's going to be well over 1,000 tons, probably closer to 1,500, I think, the way things are going. There was a very big delivery yesterday, 66 tons or something, and silver also. COMEX wasn't meant to be for this at all, but people are using it as a means of getting bullion which they can't get elsewhere. No, you're dead right. That's the easy way to do it. I don't know where to get this stuff. I'll just go and buy GLD, and they can have the damn problem. So, yeah, I mean, I think the ETFs are growing in size, but I think it's only just started. People they haven't realized that gold is, in their terms, in a bull market. In my terms, the currency is actually in a bear market, which is actually far more serious. They haven't really understood it yet, but they're sort of gradually waking up to the fact that, they don't really know why, but they really should have some gold. It's the only game in town. So, they will go. I mean, and the same with SLV. I mean, it's going to put huge strains on, the combination of COMEX and London. That's for sure, because it's just not there. So where does the manager of GLD go for it? It's going to be interesting.
To Alasdair Macleod, the turmoil at COMEX isn't a metals story. It's the warning light of a global monetary breakdown. He believes the massive credit pyramid built since the 1970s is nearing its end. When it breaks, currencies won't just weaken, they'll collapse in purchasing power. He warns it won't be gradual. Once faith in fiat dies, it happens suddenly. And then, all at once, money will flee from paper into anything tangible: gold, silver, commodities. But by then, physical supply will already be gone. Macleod expects quiet rescues when counterparties fail, but stresses these measures only delay the inevitable. Each bailout chips away at what little trust remains. As he often says, gold isn't rising, it's the value of paper that's falling. And when that truth finally spreads, gold and silver won't be viewed as investments anymore. They'll be recognized once again as money, the only form that doesn't depend on anyone else's promise. He believes that moment will mark a reset of the global financial order. Currencies repriced, debts devalued, and real wealth measured not in dollars, but in ounces. If you find Alasdair Macleod's warnings worth hearing, make sure to like this video, subscribe to Macro Edge, and share it with those who still believe the system is stable. Because, as he said many times before, when faith in paper ends, real money speaks.